Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard, your number one source for Bitcoin and Bitcoin Treasury Company analysis. We are about to commit intellectual arson on every number go up fairy tale you have heard on TikTok. I want you to picture the planet as a giant Stanford marshmallow experiment with 8 billion toddlers. Half the room is already licking the sugar off the plate, the other half is figuring out how to mortgage grandma's dentures just for one more bite. Bitcoin is the lone marshmallow that cannot be counterfeited, yet 90+% of humanity will still fail the test because the test is not about access, it is about discipline. If you look at the data, the National Longitudinal Survey of Youth shows a 0.46 correlation between intelligence and lifetime earnings. A German meta-study on delayed discounting finds that higher IQ directly tracks lower time preference. Add these two coefficients, multiply by a 21 million hard cap, compound for 3 halving cycles, and you get a distribution curve that looks less like a bell and more like a guillotine. The blade falls on people who think a seed phrase is something you bury in the backyard next to the dog. Meanwhile, institutions are scooping up liquidity faster than a Walmart Roomba. 12 spot ETFs already hold more Bitcoin than the entire population of Canada could realistically self-custody if every citizen suddenly turned into Michael Saylor. The top 100 wallets, they are the Vatican vaults of cryptography, untouchable, singing hymns in SHA 256, while the rest of the world is still arguing about whether the supply is actually fixed. So when I say why most people will never own meaningful Bitcoin, I'm not being edgy, I'm actually reading the actuarial tables. Meaningful ownership requires abstract reasoning, emotional stoicism, and technical sovereignty, 3 attributes that are rarer than a healthy American dietary guideline. If you do not cultivate them, you will rent your exposure forever. Paying custodial tithes like a medieval serf who thinks the castle moat is there for his own protection. Today, I will dissect this cognitive economic meat grinder, expose the academic receipts, and give the tinnitus of inevitability to anyone clinging to the fiat life raft. Welcome to the harsh clarity of monetary Darwinism. Time to dissect the engine that keeps the rich stacked with sats and the rest working double shifts at Wendy's. Think of this flywheel as 3 steel gears grinding together: cognition, savings, and patience. Miss even one tooth and you are face planted into fiat forever. Gear number 1, brains to books. Psychometric blunt force comes first. AFQT scores alone explain 21% of the variation in US wages. The correlation is 0.46, bigger than the link between smoking and lung cancer. Every extra IQ point that you have behaves like a quiet side hustle, adding a few $100s to annual income that keeps compounding while everyone else is buying Funko Pops on credit. Gear 2 is brains to savings. Higher intelligence quietly hikes national savings rates. The macro model from Garrett Jones shows that a 10-point IQ bump raises the steady-state savings rate by roughly 3 percentage points, enough to erase an entire sales tax bracket. Cross-country panels confirm the story. Smarter nations stash more capital and climb the growth ladder faster than influencer ebooks can teach you to manifest abundance. Gear number 3 is brains to patience. Now we're gonna fold in time preference. A meta-analysis of 24 studies finds that higher intelligence predicts lower delayed discounting with an R of -0.23, meaning smarter people actually wait for the steak instead of inhaling the fries. Low IQ cohorts, on the other hand, champion YOLO right up until their broker liquidates the margin. So there is a compound effect. If you stack these 3 gears, the torque is savage. More income funds bigger stacks, higher savings shield those stacks from lifestyle creep, and greater patience keeps hodlers calm through 80% drawdowns. If you spin this flywheel through 3 halving cycles, you get the distribution that looks like the guillotine. The top slice owns the assets, the bottom slice will pay the management fees to rent it. Welcome to the wealth centrifuge. Either you can strengthen these 3 gears, abstract reasoning, disciplined thrift, and low time preference, or prepare to admire Bitcoin through the glass of an ETF prospectus for the rest of your natural life. Picture Bitcoin as a fortified citadel guarded by 3 giant guards. Most people wander up with a Coinbase login and a TikTok dream, then get catapulted back to fiat because they cannot clear even the first gate. Gate number 1 is the skill of abstract reasoning. To walk through the arch, you need to grasp digital scarcity, cryptographic proof, and a 21 million hard cap. Concepts that live several floors above number go up memes. A European share panel study shows that higher numeracy, memory, and verbal fluency sharply raise the odds of owning risk assets. The authors found that cognitive abilities are positively associated with stock market participation, even after the 2008 crisis. Replace equities with UTXOs and the filter gets steeper because there is no quarterly report to hold. Gate number 2 is emotional control. Now the drawbridge drops 50 meters. A 2008 meta-analysis of 30 studies reports a mean correlation of R equals minus 0.23 between intelligence and delay discounting, meaning higher IQ individuals wait for the larger later payout rather than panic sell at minus 80%. In practice, that is the difference between surviving the 2018 bear market and rage quitting at the bottom to buy Dogecoin and Monster Energy. Gate number 3 is the technical sovereignty. Finally, you face the vault door of self-custody when Mt. Gox displaced 850,000 BTC, worth over $450 million at the time. Everyone who trusted the custodian lost the keys to the kingdom. A decade later, the lesson is slowly sinking in. Self-custody wallets now hold more than 35% of all crypto, up from 25% in 2022. And hardware wallet sales spiked after the FTX crater as refugees sprinted for personal cold storage. Master seed phrases, multi-sig, and air-gap devices, or resign yourself to paying custodial rent forever. Only the few who clear all 3 gates end up with meaningful Bitcoin. Everyone else becomes a customer of the ETF priesthood, swapping sovereignty for a prospectus and a management fee. In the citadel of hard money, cognitive clarity, emotional stamina, and technical competence are the only visas that count. Let us leave theory and run the numbers because the guillotine of compounding only looks merciful on paper. Start with the smallest measurable edge, a single IQ point. Longitudinal work by Zagorski finds that 1 extra point lifts annual earnings from $234 to $616 after you adjust for age, education, and every other polite excuse people give for being broke. If you plug that incremental cash flow into a plain vanilla 7% real return for 30 years, and you create $24,000 to $62,000 of additional net worth from 1 digit on your IQ test score. If you stack 10 points, the gap grows to a down payment on a Manhattan broom closet before you even talk about equity risk premia. Now, widen the frame to life cycle wealth. A recent analysis of Britain's 1970 cohort tracks kids from age 10 to their 50s and shows that cognitive ability predicts adult net wealth even after stripping out income and education effects. Intelligence is not just earning power, it is asset allocation power. Innovation pays steeper dividends. Burhan's cross-country panel shows that every point added to the 95th percentile of national IQ delivers 0.04% more patents per decade, a nonlinear surge that funnels disproportionate gains to the intellectual aristocracy. A Finnish dataset finds that if everybody leapt into the top decile of IQ, the probability of becoming an inventor would jump 183%, an explosion of option value that equity markets promptly capitalize. If you layer all these findings together, the wealth curve stops looking like a bell. It looks like a step function. Small cognitive gaps compound into lifetime chasms. Those chasms purchase patience during 80% drawdowns, and that patience reallocates the Bitcoin float from the impulsive to the stoic every single cycle. So the takeaway is brutal. The arithmetic of discipline compounds violently, and together they make the distribution of future Satoshis resemble a knife's edge. If you miss the IQ savings patience flywheel, flywheel, you are not just late to the party, you are outside paying scalpers for a livestream link. So now we have left the realm of theory and landed on-chain where every Satoshi carries a public address and zero mercy. Step 1 are the whales, the 97 largest addresses, 4 titanic clusters above 100,000 coins, and 93 in the mere 10k to 100k bracket sit on roughly 2.99 million BTC, already around 14% of the entire 21 million cap. The blockchain is a ledger, and the ledger says 15 out of every 100 future coins are spoken for. Step 2 would be the ETF priesthood. 12 US spot ETFs plus their European and Canadian cousins now warehouse about 1.25 million BTC, or 5.9% of all that will ever exist. Every share sold is another sat trapped behind a management fee paywall, burning the ladder for late climbers. Then number 3, you're going to have the corporate treasuries, this latest phenomenon that's going to skyrocket over the coming years. Public companies led by Strategy, Metaplanet, Smarter Web Company, Sequans, hold 956,000 BTC, just under 5% of the supply. Equity markets have turned Bitcoin into a balance sheet weapon, and shareholders are claiming block space you cannot buy back with tweets. Step 4 is the nation-state vault. Governments, mostly through seizure and a few strategic purchases, guard about 471,000 BTC, 2.5% of the pie. One Silk Road bust here, one Plus token crackdown there, and suddenly, sovereign treasuries own more Bitcoin than 99% of retail wallets combined. So here's the total. If you add up the whales, the ETF, the corporates, and the states, 5.7 million BTC are already functionally illiquid. 27% of the ultimate supply. More than 1 sat in 4 has crossed the moat, never to return. The inequality is by design. It's not an accident. Elementus's 2024 entity-level study pegs Bitcoin's Gini coefficient at 82.7%, lower than North Korea, but higher than the United States. The protocol of Bitcoin is open, but the distribution curve is brutal and the math is indifferent to feelings. Every halving will tighten the vice. The longer that you wait, the more your stack some sats plan becomes a lease agreement with BlackRock, Strategy, or the US Marshals Service. Own keys now or rent forever. Welcome to the meat grinder portion of the distribution curve, where polite supply and demand narratives are replaced by industrial-grade scarcity. Step 1, dry up the float. Fresh on-chain data shows that less than 23% of coins have moved in the last 6 months. In other words, over 3/4 of the supply is welded into cold storage under long-term holders. Meanwhile, the exchange balances have cratered from 3.3 million BTC in mid-2024 to under 2.8% by July 2025. This is the process of removing the very coins newcomers need to buy. Step 2, the shakeouts are going to be triggered. Each volatility shock, the March 2024 ETF reflux, the November 2024 post-all-time high bleed, or the next black swan headline acts like a centrifuge. Impatient retail sells into the abyss. Disciplined whales, ETFs, and sovereign desks are going to vacuum up the panic offers. This is not rhetoric, it is hodl. The long-term cohorts are going to absorb every capitulation spike from retail, then sit on the coins until the next halving or beyond. Step 3 for the ETFs, they just have to lock the exit doors. Once the coins cross the moat, the rent begins. Spot ETFs charge between 0.2% and 1.5% annually, micro fees that metastasize into a multi-decade tribute stream. Think of it as digital sharecropping. You can see the crop, but BlackRock owns the soil. History's invoice, remember, is pretty brutal. Mount is missing Bitcoin still haunts the bankruptcy courts. And in just the first half of 2025, investors lost $2.3 billion to hacks, scams, and wallet compromises. Every unswept seed phrase is a bounty poster for North Korean keyboard ninjas. The net result of all of this, the illiquid supply of Bitcoin ratchets higher, fees siphon the value from late adopters, and custodial blow-up shear off whatever scraps remain. The long tail is not merely priced out, it is systematically harvested for yield by the entities that solved the sovereignty puzzle first. If you are still waiting for a better entry, understand that these harvesters are already sharpening their blades. So let's fast forward 15 years. The monetary chessboard has almost finished setting up, and the remaining pawns are being taken off the table at an arithmetical pace that feels downright biblical. Number 1, the supply is a vanishing drip. By 2040, fewer than 80,000 BTC will remain unminted. 99.6% of the 21 million cap will already sit in someone's vault. After having number 8 in April 2040, the block reward falls to 0.195 BTC every 10 minutes, about $20,000 of new issuance per hour at today's price, a rounding error on global liquidity. The ETF and fund colossus BlackRock's IBIT alone has swelled to $75 billion in assets under management, pulling in fees larger than its flagship S&P 500 ETF. US spot products collectively warehouse over 1.2 million BTC with present inflow trajectories that will surpass 2 million BTC well before 2030 and could lock up a double-digit share of the float by 2040. 2025, if you haven't been able to tell, also is beginning a legislative pivot. Several US states have already steered Treasury cash into Bitcoin ETFs. This is foreshadowing the broader public fund adoption that's going to be happening. The first UK pension fund quietly placed a 3% strategic slice into spot BTC in 2024. Copycat boards will follow as fiduciary fear turns into FOMO. And yes, Harvard actually even did this. Harvard bought IBIT. Public companies now treat Bitcoin as balance sheet alpha. Extrapolating current headlines puts over 1.5 million BTC under the corporate lock and key by the time reward emissions drop below 0.2 BTC. Retail latecomers will find the asset fenced behind custodial toll booths, management fees, swap spreads, rehypothecation haircut, all compounding forever while on-chain Satoshis stay totally immobile. The shift is permanent. Bitcoin migrates from a bearer asset to an institutional reserve, and most humans interact with it the way someone owns gold today, via a line item in someone else's vault. The bottom line, the year 2040 is not a finish line. You need to treat it like it's the last call. After that, meaningful new supply is statistically almost irrelevant, and the only meaningful question left is whose balance sheet your exposure subsidizes. Everything up to now was a diagnosis. Here is the prescription that actually works, backed by hard data and classical monetary theory. No motivational fluff required. Acquire Bitcoin and self-custody now. Hardware wallet shipments topped 5.8 million units in 2024, and surveys show 71% of crypto users prefer cold storage devices for key control. The market is voting with its wallet, literally. Number 2, study sound money. Ludwig von Mises's human action and his regression theorem explain why money must arise from a commodity with prior non-monetary value. Bitcoin's energy-anchored scarcity fits this rule. IOUs do not. If you master this framework, every dip feels like a discount on a visceral level, not an existential crisis. Number 3, you need to automate institutional grade discipline. A 5-year dollar cost averaging program that invested $26,100 into Bitcoin grew to $55,431, beating an S&P dollar cost average by almost 3-to-1. The edge is mechanical, not emotional. Set automated buys, sweep straight to cold storage, and remove yourself from the dopamine loop entirely. You need to front-run the next consolidation wave. You need to escape the spot ETF fees. They range from 0.2% to 1.5% per year. You are going to pay those forever, and you become a yield farm for BlackRock. Hold the keys now, and that fee stream compounds to your family instead. The legislative momentum is moving towards sovereign and pension accumulation. Wyoming and New Hampshire already drafted strategic reserve bills. The federal treasury is studying a million Bitcoin stockpile. You need to front-run institutions before their bids shut the door. Bitcoin rewards cognitive clarity, emotional stamina, and technical sovereignty. Cultivate all three of these. Lock your UTXOs in a multi-sig vault. Let the compounding do the talking. Fail and you will lease your financial future to the very entities that you are trying to escape. My name is Adam Livingston. I am the Bitcoin Wizard. Thank you so much for watching. If you enjoyed this content, please like this video, subscribe to the channel, and leave a comment with what you would like me to comment on next. Have a terrific day, folks. Class dismissed.